Nitin, what's your sense of what this market is primed to do right now, given the global and local fears? Is it looking like a break of the range is likely?
I think, we were joking yesterday that even though the market's at 18,000 Sensex, it feels like it's at 8,000 from a sentiment perspective, and I think some of that's likely to play out, especially with the cut we've seen globally. Clearly, we've had some local issues with inflation and interest rates and politics and policies, and now we've had some global issues resurfacing. So it doesn't look very pretty in the very short term. But let's keep in mind the silver lining that stays behind every cloud. And I think in this case, if we do see a global cut, I think it's going to be across asset classes, including commodities, especially oil. And I think that's probably the best news we can get in the very short term for our markets as well. So I think it's really a mixed bag right now. The very short term knee-jerk reaction will probably be negative, but I think we need to look beyond and see what that means for the longer term.
Then what do you think? How much is riding on today's policy and its tone? Because now it seems that the decision for the market may not be so much based on what the RBI says. It's going back to global cues and what they determine.
I think clearly there is a certain consensus about 25 basis points hike. There's an outside chance of more than 25, which I don't think the market is pricing in or expecting. I think also there are two or three other key things that people will look for. One will be the tone, whether it stays, the stance stays hawkish, or they have an indication of the end of the cycle, which I don't think will change from the last time. And also, do they do anything to the provisioning norms or the capital adequacy ratios for NBFCs and banks? And I think that also will be something that market will look for, especially if they introduce some norms for provisioning on sector basis, especially things like real estate construction. So I think it's not just the interest rate hike. Clearly, 25 basis points is priced in. But if it's more than that, then the market will have a negative reaction. But it's also the overall, positioning that the RBI takes over the next, for the next quarter or two.
You guys had an ETF conclave yesterday, Nitin. What are you hearing about incremental liquidity into this market? Because while there's a lot of talk about value, the money hasn't come through either via an ETF route or via any long-only action.
I think clearly the global ETF flows into India have been flat at best, and based on what we heard from our US guest speaker, his response really was that while they haven't seen any flight of capital at all, and they've only seen marginal redemptions, it's really been a very steady long-term flow. So I think that's pretty much sums it up in terms of what the global flows are. It's at best neutral. Domestically, again, the flows are fairly muted as well, and I think that's a reflection of what's going on the markets overall, both institutional and retail side. So I think it's just really a question of wait and watch and continuing to take the message out of different structures that are available, including ETFs, and that was all the Conclave was all about.
Nitin, is there more downside to the interest rate sensitives that you were speaking about? I mean, autos have been underperforming of late, banks have been sticky, and real estate out of action. Whichever way the RBI speaks, do you expect more underperformance from these sectors?
I mean, clearly we've started to see a little bit of impact of the interest rate cycle, in the numbers. Even if you look at auto sales, I mean, they've started to peter off based on at least the impact of interest rates, both actually commodity high price increases and the interest rate hikes. So I think clearly, till such time that we see the interest rate cycle peak out, one really needs to be, very watchful of what impact we might have. The longer we stay in this high interest rate cycle, the deeper the impact will be. Also, the longer, the sharper the RBI response towards the end of the cycle, the deeper the impact will be again. So I think it's at this point in time, it's clearly something that is a cause for concern for some sectors like auto and banks, especially. Even in banks, we've seen while deposit growth is increased from 17 to 18%, loan growth kind of down by about 1%. So clearly, that will have an impact on numbers.
Nitin, the bear case analysis for global markets is that the Dow actually sees something like a 10% cut over the course of the next few months. Is that a real fear to your mind? And what does that mean in terms of downside risk for India, given how bad our first half has been already?
Again, I think one has to keep things in perspective, especially from the point of view of, I think the dynamics of the US markets and our markets are very different. And on a longer term basis, we've seen correlations actually lowest with the US. So yes, it has an impact on global sentiment, but I think it just might be the right environment for our market to actually do better, partly because of the commodity correlation. I think that's very much a likelihood scenario going forward, in sense commodity prices cooling off even more. and also partly because I think just the focus on growth will come back, and if there is no growth in the West, and again we'll start seeing a little more attention being given to the emerging markets like ours.
Nitin, interesting observation that was made earlier, which is that the pressure point has gone from the banks to the oil and gas space now. I mean, that is the sector that is impacting the market the most. Would you go with that, given the way Reliance and ONGC have moved?
I think, from a banking space, we've already seen most PSU banks at price to book 1, and there isn't much to do on the downside from that point onwards. Private sector banks are still holding up pretty well because they've always been a buy on dip story. So I don't think banks will probably see as much action, barring maybe one or two selected names that are favorites for traders. On the OMCs, clearly I think there's going to be action and activity. Now, whether they lead the market on the downside or not remains to be seen, because while there's been some talk of deregulation on the diesel front as well, and we've seen activity on the oil prices globally. So I think it's really that really seems to be the space to watch from an action perspective, but whether they will lead the downside or not, it remains to be seen.
Nitin, we were speaking to another economist who pointed out that there was a 40% probability, to his mind, of a 50 bips move from the RBI. If that were to happen, how do you think the equity market would read it?
I think the immediate reaction will be fairly negative, primarily because that indicates that even towards the end of the tightening cycle, if we are getting more aggressive, then the impact on the underlying economy slowdown and corporate earnings will be much deeper. So I think expectation right now is clearly 25 basis points. There is an odd chance of 50. I don't think 40% is the right number, but I think it's a fairly small number as far as we can see it. So clearly the short-term impact will be very negative.